Welcome back to the Manor. Julian McBain here, and today we are back in Panleon Cave, of course. Spent a lot of time in this cave recently. Have you noticed that? Just trying to get through the Panleon challenge. I'm doing a lot of swunting, as you all know. I'm working on the profitability challenge for 2022. I'm actually over 300 ped up for the year. So I'm doing okay. 300 ped isn't a lot, of course, and I had a lot of ammo left over from last year, so that can't necessarily call that a true profit, but it's certainly better than I've done in years past at this point, so we're doing good there. Today we're going to be talking about property insurance, which is the next topic in the list of things that we're doing for personal finance for gamers. But there's a couple of things I want to talk about real quick. First, of course, before we get started, if you're new to the channel, welcome to the Manor. Please take a moment and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. Also, please consider going to patreon.com/JulianMcBain if you want to support my work. If you do, you'll get exclusive content, including the booklet that is the basis for all of these videos on personal finance for gamers. I will be working on a second edition sometime this year, as soon as my schedule loosens up a little bit, which, of course, has been crazy. So, there is that. I also want to kind of do a product shout out, and I don't do this very often. I'm not sponsored by anyone except for my patrons, so this is not a paid sponsorship, but I need to give a huge shout out to GamerSupps, because without these guys, there's no way in hell I'd be able to keep my energy up to do all the shit that I do in a week. Currently, I work full-time, I'm a single father, and at least until the end of March, I'm technically in school full-time too. Plus, I'm the treasurer of the Vermont Libertarian Party. It's an insane schedule. I don't know why I do this to myself. Yesterday, I was so busy. I schoolwork and meetings, and oh yeah, I helped fell 4 trees. So, no one can dispute my redneck credentials on top of the fact that I wear a suit. So, without the energy that GamerSupps gives me, with no discomfort, I would not be able to keep up. Like, when I was running off of 12 cups of coffee, I was still drowsy, and I still take naps from time to time because I'm old, but GamerSupps, guys, 110%. The other thing I wanted to kind of give a shout out to, this is a little known treasure, and I recommend, this is not a financial recommendation, but for those of you who are looking at things like gold in order to diversify, in order to hedge, this is a gold back. This is 1/1000th of a troy ounce of gold. This note is worth approximately $4 when you break it down. There is actual gold built into here. It's gold, thinly gold foil applied to polyester. They come in various notes. This one's a New Hampshire issue. They're voluntary currency. I would strongly recommend, if you're a person who's looking into gold, to look into it, because it's a great way to be able to acquire small amounts of gold without having to make a huge financial commitment. Delivered to me in 5 days, 4 business days, because I ordered them on a Saturday, so that doesn't count. Plus, there are states where you can actually spend them like currency. New Hampshire is one of them. That's a New Hampshire issue note. I chose New Hampshire because, 1, it's the next state over, and 2, that's where I was born. I have a lot of family ties in New Hampshire. I've got a lot of emotional ties to New Hampshire, so I always choose New Hampshire, but I know Utah and I believe Nevada also have their own issuances of gold backs. They're all weighted the same. They're standardized, so it doesn't matter what the name of the state is on them. Go check that out. Okay, once again, neither of these are paid sponsorships. I just love both of these products so much that I had to shout them out. Okay, let's talk about property insurance. And I know that insurance is something that a lot of people don't like talking about. One, for some people, insurance is expensive. It is an expense you got to pay every single month, especially like on your car. People just don't like talking about insurance, but insurance is your defense. So it's really important that you understand the aspects of insurance that are critical for you in order to understand how to protect your finances from loss. Property insurance covers exactly what it says it does: your property. Now, there are some limitations to what property it covers. There are things called perils that tell you what kind of losses are covered, and if it's not listed as a peril, then it's not covered. And so whenever you're buying insurance, you really need to take care to read through your contract to understand what is covered. So the two types of property insurance most people deal with are auto and homeowners. And of course there are, and both of those insurance policies also have casualty insurance built in. I'm going to talk about casualty insurance, also known as liability, in another episode. We're going to focus on the property aspects now. We're going to go through some terms so that you can better understand what you're getting into. Rule number 1. Like all insurance, property insurance, you get what you pay for. You 100% get what you pay for. And does that mean that there aren't going to be companies out there that can give you an absurdly better rate than what you're getting now? Of course there's going to be. Some companies are just positioned in a way or have their portfolio in such a way that they do really well on certain types of policies. Example, condominium homeowners association policies. These tend to be very expensive because they're covering vast amounts of property. I happen to know of a company that can do the same coverages or better because they have fewer exclusions for almost half the rate of the average company. The reason they can do that is because they have so many condo associations insured that a single loss, no matter how large, would not drastically affect the amount of premium they'd have to collect from all of the other associations. See, when you buy insurance, you're pooling your money together to mitigate your risk. And that risk pool, those monies from premiums are invested into funds. And when claims are paid out, they're pulled from those funds. And what I mean by fund is we're talking literal mutual funds with bonds in them, generally speaking. And if you're in a mutual company, which means the policyholders are the owners, that insurance company has, I believe it's a statutory 4% limitation on profit that it can rake in year over year. It's actually very much regulated, very heavily regulated on what they can do. Otherwise, they have to reduce premiums because they're owned by their policyholders. It would otherwise have to be returned to the policyholder as a dividend, which would be classified as a return of premium. So like a dividend on a mutual insurance company's policies are considered a return of premium, and so they're not taxable, unlike the dividends you get from like a stock. Confused yet? Yes, I know, clear as mud. Anyway, property insurance, kind of going off on a tangent here. Things you need to watch out for on property insurance. And this is going to focus more on the homeowner side than the auto side, but we're going to get into auto toward the second half of the video. On homeowners, there are 3 types of policies you need to look at. Be very aware of which kind you get and talk to your insurance person before making a purchase, especially if you see, wow, this is really cheap compared to what I have. This is the question you want to ask. What is the form of insurance? Because there's 3 forms: basic, broad, and special. Basic is just that. It covers 3 things: fire, lightning, internal explosion. That's it. That's literally it. Pipes burst, not covered. Sorry. Windstorm, not covered. Now, you can purchase additional perils to add to the basic form, and these are called optional coverages, and you'd have to talk to your insurance provider about adding those in. And generally speaking, on a homeowner's, this is more, basic perils is more for like a rental dwelling or a dwelling that is not necessarily lived in. It doesn't generally have ancillary coverages, but I'm going to cover it. I'm talking about it just to kind of cover my bases, because you never know what the broker's offering you. Always be sure to check the perils that you're insured for. Basic's going to be super cheap. It's not going to cover very much. Next form is called broad form. This is also known as a 17 peril policy. It covers the vast majority of all losses: fire, wind, hail, lightning, all explosions, missiles dropping from the missiles that are not like rocket missiles. We're talking like things flung, meteors. All of that's covered by a broad form. It does cover the vast majority of things that could happen to a home or to your stuff. That being said, there are numerous exclusions. The last one is special. This is also known as an open perils policy. Basically, what an open perils policy is if it's not listed in the exclusions, we cover it. So broad form covers 17 specific perils that are the most common forms of loss, and generally speaking will be adequate, but there are going to be things that aren't covered that you might want. Special form, if it's not excluded, it's automatically covered. Most companies now default to special form coverage. And there's a couple of reasons for that. One, because the top tier insurance companies only carry special form, people assume that's what they're getting. And you don't want, an insurance company is not going to put itself up for the liability of not covering something that a customer thought was covered just by a cursory look at the policy. Now, that being said, you as the customer are expected to read your policy documents. And if you don't read your policy documents, that's on you, not the insurance provider. The one thing about finance most people don't get is that it has a heavy hand of personal responsibility. If you're not responsible enough to pay attention to your bank accounts or your insurance policy or what's covered, that's on you as the purchaser. That's not on your insurance provider. That's not on your broker. That's not on your banker. That's on you. So pay attention to what's covered. Just as importantly, pay attention to what's not covered. So a couple of things that are automatically not covered by default. And keep in mind, my European friends or friends in other countries, I don't know that I have viewers in Asia or Africa, and if I do, awesome. Drop a comment. I'd love to see it. But for those of you who are not in the United States, check to see how the law works in your country. This, of course, is based on US because that's what I know. Common exclusions, think that will never be covered by, say, a homeowner's. Flood. I know. You'd expect it to be, but it's not. And there's a very specific definition of flood, and this is again based on the US system. According to the Federal Emergency Management Administration, flood is groundwater or overflow from a body of water covering 2 acres or more or affecting 2 properties or more. And if it doesn't fall under that, it's not classified as flood. That being said, the flood exclusion in a homeowner's policy states that any form of groundwater or outside water coming in, such as water welling up from underneath the ground, a river that overflows into the house, even if it doesn't qualify for coverage under a flood policy that you'll have to purchase for a ridiculous amount of money. Yes, flood insurance is stupid expensive. The average flood policy that I've written is between $4,000 and $6,000 a year. And there's severe limitations on what they cover. Tangents. Those waters are not covered. That's all on you. This is one of the reasons I like having basements, because basements take far less damage from a flood situation than the wood structure of a house. Okay. Other common things that are excluded: war, nuclear threat, or disaster. These are all things that you want to pay attention to. Now, the chances of a lot of these perils ever being an issue, flood excluded, are relatively low. Oh, earthquake is usually excluded too, but you can endorse that into most policies. Check with your insurance provider. Speaking of earthquake and flood, landslide versus mudslide. Landslide, earthquake. Mudslide is flood. So the determination is whether there's a sufficient amount of water to classify it as mud. Because mudslide is classified as a flood problem, whereas landslide is considered an earthquake or earth movement problem is the technical term. So just be aware of that. Okay. You've gone through, you know what's covered by your contract, you know what's not covered by your contract. These are all very important. Okay, now how is your home fixed? There are 2 versions. This is another thing you want to pay attention to, and this will always be in the contract. Replacement cost versus actual cash value. And now let's talk about that for just a minute. First off, you're going to notice that your home is not covered for market value, nor should it be. Market value and replacement cost are almost never the same. What you want it covered for is 100% replacement cost. What that means is if your house burns down, the insurance company is responsible to rebuild the house as close to the original as possible based on that replacement cost. And there's almost universally most companies build in an additional amount of money over replacement cost if you're insured to 100%. in case inflation does something or it's hard to find contractors. This is especially important if you're in a really old home, because the insurance company is responsible to rebuild it, depending on the option you take with them. For instance, the company I work for will rebuild a home using the exact techniques and materials that were used when it was originally built, if the option is taken, which is done by default. You have to opt out of it. So, like, similar construction using period techniques, that company will rebuild a house that had hand-hewn beams by hiring contractors that can hand-hew beams to rebuild it in 2022, the same way they built homes back in 1650. Companies do that. Companies do that. So, pay attention to all those things. Some of them will just rebuild it using modern techniques and materials. And for most people, they're cool with that. But they're still responsible to insure it up to the original value, the original replacement of the home. So, if you've got lath and plaster, they have to insure it as if they have to replace lath and plaster. That's the law. Sorry, guys. Which is expensive, by the way. So replacement cost means they have to keep rebuilding it up to the replacement value of the home 100%. Actual cash value, basically you're getting a check that's worth less than the rebuild of your home. It's the actual cash value of the materials in the home at the time of the loss. That includes depreciation. This is especially common on manufactured homes. We would also call them trailer homes, or mobile homes. Actual cash value is unfortunately a fact of life on a lot of those homes. I only know of one company that does mobile homes to replacement cost regardless of how old they are. There's significant additional exposure and risks when it comes to those types of homes, which is why they're only insured to actual cash value. But basically, if you have an actual cash value policy, just be aware that if you suffer a loss, especially a total loss, your home's not being replaced. You're getting a settlement check. And you're going to be responsible for the rest of the rebuild. And that's unfortunately just the way it is. So that's another thing you want to look out for. Does it say replacement cost? Does it say 100% replacement cost? Or does it say actual cash value? The amount that the home is insured to will determine whether it's a replacement cost or actual cash value policy. So if you have a 70%, if you're, as the consumer, you have the option not to insure your home to its full value as long as you don't have a mortgage on it. The bank only cares if the mortgage is covered, but you're going to care about your home. And so some agencies or companies won't do this, but there are those out there that will. So as an example, you can insure your home to 70% of value. So that's going to trigger two things. One, any policy that's below 80% replacement cost will not be a replacement cost policy that automatically switches it to actual cash value no matter what. Doesn't matter what kind of home you're in, doesn't matter other factors, it's actual cash value. Not only that, but any loss is prorated to the percentage that you choose. So if you've got a 70% policy and you suffer a $100,000 loss, the insurance company is only paying 70 grand of that regardless of the actual cash value. Sorry, kids, that's the way that works. One, it's to discourage people from doing that to try to save money, because really it's just a pain in the ass for you and for the insurance company and for all the lawyers that get involved in that shit. Two, it really is a detriment to everyone involved. So just be aware of that. So we covered exposures, perils, replacement versus actual cash value. Those are really the major points. There's a bunch of nuanced points that I could get into, but honestly, if you're not getting licensed in this shit, you really don't need to know. And if you are getting licensed in this, please go check out one of the good licensing companies out there. There are all kinds of people out there that do this professionally. What all they do is teach this stuff. And honestly, it's good for anyone to know. Unfortunately, the schooling to do it, you're open to it for 2 months and it costs you like $250. It's not cheap. So just be aware of that. I'm really giving you some high top level stuff to make it as universal as possible. I strongly recommend you talk to your own insurance agent about the specifics in your state or country, because it's nuanced. Now, insurance has been around since 1650. we started things by insuring ships, and that was by Lloyd's of London, who is the oldest insurance underwriter in the world. I will give props where props are due. Lloyd's of London has been around forever, and they literally cover anything, but you pay for it because they're an underwriting syndicate, not an insurance company. And no, I'm not going to get into that. You can look it up. That would be a whole episode on its own. So, okay, let's flip a little bit and move to auto. The property sections of auto insurance are your comprehensive and collision. And a lot of you are going, but what about bodily injury? No, that's casualty insurance. See how that works? We're going to talk about casualty next time. Talking about property today. The property section of your auto insurance is generally the comprehensive and collision portions. And you're probably going, okay, well, what do these things cover? And the first thing you need to understand is, like other insurances, you get what you pay for. The higher your deductible, the more you pay out of pocket before the insurance kicks in. This is especially important in states where there is not separated glass coverage. In fact, I know of someone on my Facebook friends list who is really upset that the windshield that he had wasn't covered by his insurance because he chose a $1,000 deductible. And he thought it was morally reprehensible that they wouldn't cover it. I'm like, dude, did you read your contract? It specifically states that glass coverage is part of comprehensive, and if your deductible is over the value of the windshield, you're going to have to pay it out of pocket. That's the way that works. It's not morally reprehensible. That's the contract that you agreed to pay for. So okay. Let's talk about what collision and comprehensive are. And these are both properties. They both replace your vehicle. And they are replacement cost up to the value of the vehicle. What does that mean? If something happens to your car, it crunches a quarter panel. Quarter panel costs, I don't know, $3,000. It's not that much. But just for the sake of argument, we're going to put an arbitrary number on it. Okay? Whatever the damage is, the repair cost is $3,000. Minus your deductible, let's assume it's $500, so the insurance company is going to pay $2,500. If the total damage to the vehicle is less than the value of the vehicle, the insurance company is going to pay to replace the parts and repair the vehicle. If the damage to the vehicle is more than a fixed percentage of the value of the vehicle, usually 75 to 80%, then it's a total loss, and they just cut you a check for the value of the vehicle minus your deductible. So as an example, you have a car, tree falls on it. You know, you've got your deductible to pay, it's $500, but the car is totaled. The car is worth $5,000. They cut you a check for $4,500. You send them the title and the keys. That's how that works. It's more complicated than that, but in the end, not really. Especially if it's a tree. Okay. What are the difference between... Because people hear the term full coverage. Full coverage is not a thing. I don't care what your person says, full coverage is not a thing. It is not an industry term. It is not used anywhere in the United States, and I doubt it's used anywhere in the world. Most people think of full coverage as comprehensive and collision, and most people don't understand what comprehensive and collision cover. So let's cover that quickly. No pun intended. Collision covers your vehicle in the event you run into someone or something. So you're driving, or if it pops out of gear while you're not occupying it, this is technically a form of collision. It covers the repairs to your vehicle. It does not cover the other party's vehicle. That's part of casualty insurance. It covers your vehicle minus deductible. The most common deductible on collision, particularly if there is a lien or a lease on it, is $500. I'd recommend not going any higher than that because then it creates a significant possibility for financial hardship in the event you're in an accident, where you may already be dealing with other things like injury. So that's what collision covers. Comprehensive covers your vehicle in the event something happens to the vehicle, meaning a tree falls on it, floodwaters carry it away. Yes, flood is a covered peril for auto insurance, even though it's not for home. A tornado whips it up, deer jumps out in front of you, bear decides to use it as a napping spot. Yes, that's happened. So it's all a matter of, and by the way, all animal issues are comprehensive. Basically, your quote-unquote acts of God. Anytime you're driving the vehicle and you run into something, that's automatically collision. even if they say, "Oh, I wasn't at fault," it doesn't matter who's at fault. It's who's responsible. There's a difference. We've talked about this on the channel before. The difference between fault and responsibility. If you run into something and you're driving, you go off the roads are icy, doesn't matter. You're still responsible for the accident. That's collision. And there's always a deductible involved. Many companies offer a zero deductible on comprehensive, meaning any damage to the car that you had no fault in or no hand in is automatically covered for zero deductible. If you don't have a separate glass coverage in your state, I would strongly recommend taking that zero deductible. That way, if something happens to your windshield, you're not paying out of pocket, or keep a low deductible like $100. Comprehensive isn't even despite the name, comprehensive isn't the expensive insurance. I have comprehensive on my Saturn, and my Saturn's a million years old. Mostly because I live in Vermont, where stone chips on windshields are a dime a dozen. I probably handle 3 to 5 glass claims a month easily, and I'm not the guy who handles most claims. That's usually done by one of my reps, and she does one a week easy. So, windshields, especially now with these new windshields that are like $750 to $800 a windshield because of all the sensors on your newer vehicles, get a low comprehensive deductible. It's not going to cost you a lot more. Collision's the more expensive one, and $0 deductible is not a thing, as far as I know, from any insurance company in America. The lower your deductible, the more you're going to pay. The younger you are, the more expensive that's going to be. And that's just a function of life. So my recommendation, see what you can afford. Default to a low comprehensive deductible. If you have to make the exception, make it on your collision. Talk to your insurance agent. Let them talk to you about what your options are. Realistically speaking, your agent for your state is going to be your best resource on how to cover your home and your vehicle, because every state is different. Insurance is covered at the state level in the United States because the states are technically the basis of sovereignty in this country, because we're not a unified nation. We are a federation. I'm not going to get into that whole thing. I think I've covered that in the past before. So anyway, that's property insurance in a nutshell. I could probably spend hours doing lectures on this. I'm not going to do that to you. Maybe in the future, if there's a lot of requests for it, I can dig out my ye old insurance study guide and really break it down for you, because the insurance study guide is this thick, and roughly half of it's property insurance. So, I know you see my fingers apart, and it's about 2 inches thick. But that's the basics of property insurance. In the next episode, we'll get into the basics of casualty insurance, and then we'll move on to life. So, in the meantime, thank you for watching. Thank you for listening. Please like, share, and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. And as always, I really appreciate all of the support, and we will see you in the next one.